65 million American households, the entire bottom half of the country together, own 1.1% of the stock market. The richest 10% own 87% of it. And here is the uncomfortable part. That gap is not mostly about salaries. Two families can earn the same paycheck and end up on opposite sides of it, because of one line most of us were never taught. Here is the scoreboard, straight from the Federal Reserve's own ledger of who owns what. Of every dollar of stocks and stock funds in America, the wealthiest 10% of households hold 87.4 cents. The bottom 50%, half the country, hold about a penny. Two Americas, one balance sheet apart. So what do the people on the winning side know? They know the difference between two words that sound like accounting and decide almost everything. Act 1, the one-line test. Forget the textbook definitions for a second and use the plumbing version. An asset is anything that reliably puts money into your pocket: dividends, interest, rent, business income. A liability is anything that takes money: OUT payments, interest charges, insurance, upkeep. Notice what this test ignores. It does not care what a thing cost, how impressive it looks, or what the salesman called it. It only asks one question: which direction does the cash flow? Now run the things you were sold as assets through that test. A new car on a 72-month loan, the biggest house the bank will approve, electronics on a payment plan. Every one of them takes money out of your pocket every single month. Meanwhile, the boring stuff: index funds, a small business, bonds, a home you can actually afford, quietly pays you for owning it. Here is the trap. The first list is heavily advertised. The second list has no commercials. The plainest version of this rule appeared in a 1997 bestseller. An asset puts money in your pocket, a liability takes money out. Accountants have argued about that definition for almost 30 years. Technically, your car is an asset on paper. But as a household operating rule, the cash flow version has one advantage over the technical one. It predicts who ends up wealthy. And the machine that blurred that line for everyone was switched on in 1919. General Motors had a problem. Cars cost more than people had in cash. So GM created its own finance company, GMAC, and invented the modern car payment. It worked spectacularly. Within a decade, most new cars in America were bought on installments, and an entire economy learned a new habit: if you cannot afford it, finance it. A century later, that habit has a shape. The paycheck arrives. The payments go out: the car, the cards, the subscriptions. The stuff the payments bought quietly loses value the whole time, and when the loan finally ends, the car is worn out, so the cycle restarts with a new one. Money flowed through the household for 30 years, and none of it stuck. That is the treadmill. It is not a moral failure. It is a design. And the treadmill has never run faster than right now. In the first quarter of 2026, the average payment on a NEW car in America hit $770 a month, an all-time record on an average loan of nearly $44,000. Hold that number in your head. $770 every month. We are going to see what else it can do in a few minutes. Because here is what that $770 a month is actually buying. The average vehicle sheds 45.6% of its value in its first 5 years, roughly $17,000 gone, not to bad luck, but to simple depreciation. Nearly half the biggest purchase most families make, evaporating on a schedule. The bank still gets paid in full. The depreciation is all yours. So that is one side of the line. Act 2, what the other side of the line actually owns. Put the whole stock market on one chart. The top 1% of households own 50.2% of it, half the market, 1% of the people. The next 9% own another 37.2%. The entire American middle class, the 50th to the 90th percentile, owns 11.5%. And the bottom half of the country splits 1.1%. the single most powerful compounding machine ever built, and almost all of it is plugged into the top 10%. Now here is the twist most people miss. 58% of American families do own some stock through a retirement account, a fund, a few shares. Ownership is not rare. Owning enough for it to matter is. For most families, the holding is a sliver, a side dish next to the car loan and the mortgage. The rich do not just own stocks. They make stocks the main course of the balance sheet. Why does that difference explode over time? Because the two columns move differently. A liability amortizes. You pay it down to zero and keep an object worth half what you paid. An asset compounds. It pays you, then pays you on what it paid you. Run the same $770 a month both ways. Into a new car cycle after 10 years, cars that kept losing half their value. Into broad markets at a 7% average. Return that same payment is about $133,000 in 10 years, and roughly $939,000 over 30. Same paycheck, same discipline, opposite direction of cash flow. There is one asset the American middle class did manage to buy at scale: the house. 66% of families own their home, and for most of them, it is the balance sheet, the forced savings plan that actually worked. That is exactly why the wealth statistics split so violently along one line: whether you own where you live. How violently? The median American homeowner is worth $396,200. The median renter is worth $10,400. That is a 38x gap, not between rich and poor, but between the middle of one group and the middle of the other. Same country, same economy. One of them has been quietly buying an asset every month for decades. The other has been buying a landlord one. Which brings us to the only question that matters. Can you switch sides? Act 3, reversing the flow. The wealthy run the pipeline in the opposite order, and the order is the entire secret. Income arrives. Assets get bought first automatically before lifestyle gets a vote. The assets start throwing off their own cash dividends, interest, appreciation, rent. And the comforts, when they come, get paid for increasingly by the assets, not the paycheck. Same pipeline, same pipes. It just runs in reverse, and it fills instead of drains. And if you want proof that compounding is real, look at where it is pointed at most households: backwards. Americans currently carry $1.25 trillion of credit card debt at an average interest rate of 22.15% on accounts carrying a balance. That is the same exponential math that builds fortunes in the market running in reverse, against the borrower, at triple the market's historical speed. Compounding does not care which side you are on, it just runs. So what transfers to you? 1. Run the cash flow test on every big purchase. Which direction does the money move after you buy it? 2. Know what each thing really is. The financed car is the lender's asset. You are the yield. 3. Pay attention to order. Households that buy assets first and comforts second end up on the left side of every chart in this episode. And 4. The 1.1% statistic is not a life sentence. 58% of families already own the rails. The machine is open to anyone who redirects the flow. Remember the number we started with. The bottom half of America holds 1.1% of the stocks and 2.5% of the wealth. Not because half the country is lazy, but because for a century, one side of the balance sheet has been advertised at them, and the other side never bought a commercial. Assets feed you. Liabilities eat you, and every dollar you ever earn will pick a side. If this episode rewired how you look at your own balance sheet, subscribe. Every number you just heard is sourced in the description, along with the rest of the Mechanics channels. Because next week we open up the single most powerful asset on that chart. Index funds, the boring machine that beats 90% of the professionals. The more you understand the machine, better you can play it. See you in the next one.